Today, I'd like to discuss the potential impact of the AMC conversion and the small share issue on the squeeze. I'll explain why extensive dilution can be detrimental, but how a smaller amount of dilution, combined with the closure of smaller short positions, could lead to the squeeze. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But everyone remember, this is not a financial advice video. Pip and Sammy recently tweeted about the estimated $16 billion cash raise, suggesting that it could translate to around $5 per share pre-split or $50 per share post-split. However, they also mentioned that AMC has the potential to increase these numbers even further after the reverse split. They argued that AMC could easily raise the required $5 billion to pay off its debt without selling too many shares, especially if the price of AMC rises after the conversion. I've previously mentioned that AMC is likely to experience a surge after the conversion due to short players closing their positions. Additionally, Spence added that legacy AMC shorts would use their converted AP shares, which convert into AMC shares, to cover their short positions. This mainly applies to smaller shorts, as the larger players have created a significant number of synthetic shares by selling the float multiple times over. Therefore, the conversion period presents an opportunity for the smaller hedge funds, holding only a few hundred million short shares, to close their positions, driving the price of AMC higher. This scenario would result in AMC having a reduced share float of 150 million shares, allowing Adam Aron to raise substantial cash without selling too many shares. Let's consider some numerical examples. Currently, AMC carries a debt of around $5 billion and holds approximately $1 billion in cash. To completely clear the debt, AMC needs to raise at least $4 billion. If AMC sells shares at $40 per share, below analyst estimates, they would have to sell 100 million shares post-split, equivalent to 1 billion shares pre-split. This is a significant number of shares. However, if the price of AMC rises during the conversion period due to short closure by arbitrage and legacy shorts, Adam Aron could raise the necessary cash by selling significantly fewer shares. For instance, if the price reaches $200 per share post-split, equivalent to $20 per share pre-split, Aron would only need to sell 50 million shares. Similarly, if the price hits $400 per share post-split, $40 per share pre-split, which AMC has achieved before, Aron would only need to sell 10 million shares. Selling just 10 million shares at $400 per share post-split would raise the required $4 billion in cash while causing minimal damage to the AMC flow. However, it's important to note that the news of debt clearance, combined with the closure of legacy short positions and arbitrage shorts, could potentially trigger a squeeze. If the price quickly rises to $40 per share pre-split or $400 per share post-split, it could instigate a short squeeze by putting the larger shorts at risk of failing their margin requirements. Frank's Place emphasized the significance of deleting every fundamental reason for shorting AMC. According to him, once the AMC debt is eliminated, the short narrative will no longer hold weight. This explains why shorts and shills are desperate for shareholders to sell their AMC shares before the conversion takes place. They want to create a narrative that the AMC squeeze play is over after the conversion, which is why they want shareholders to act swiftly. They fear the conversion and reverse split because they know it can clear the debt with minimal shares sold. The closure of short positions, combined with the ensuing FOMO and momentum traders entering the market, could contribute to a squeeze. In this scenario, Aron would only need to sell 10 million shares to eliminate AMC's entire debt, effectively nullifying the short thesis. However, it's crucial to consider the adverse effects of massive dilution. Hang Loose mentioned that Citadel would gladly pay $16 billion to be free of their entire AMC short position, including synthetic shares. They see the potential for trillions in the mother of all short squeezes. so covering the $16 billion would be a gift to them. If Aaron were to sell the full 400 million shares, 4 billion shares pre-split, it would enable Citadel to close their synthetic shorts entirely, assuming there are between 2 and 4 billion synthetic shares. Therefore, unless AMC is on the brink of bankruptcy, which is no longer a threat, massive dilution should be avoided. While selling just 10 million shares to pay off AMC's entire debt would be beneficial, diluting the market with 400 million shares would have severe consequences. Jim Cramer also highlighted the struggles shorts are facing in the broader market, mentioning numerous short squeezes. Although these squeezes did not involve AMC, GameStop, or APE, they occurred in smaller growth stocks like Carvana, Coinbase, and Affirm. The crazy lady trader welcomes these short squeezes, anticipating that the most dangerous ones will occur last. This aligns with my previous observations that tech stocks would be the first to experience short closures, followed by risky growth stocks, smaller meme stocks, and finally, AMC and GameStop. The shorts in AMC and GameStop pose the greatest threat to hedge funds. While the squeeze in a small stock like Carvana may affect 1 or 2 hedge funds at most, a squeeze in AMC or GameStop could potentially decimate the entire hedge fund industry. Frank highlighted the exorbitant cost to borrow for AMC, exceeding 1,000%. He questioned why it is cheaper for hedge funds to borrow a stock at such a high markup rather than buy it, even if it's a synthetic share. Why would shorts pay 10 times the total short position to short a stock, which is not a profitable venture, instead of buying back shares and closing their positions early? Currently, shorts can make a maximum of $4 per share by shorting AMC, but they are willing to pay over $40 per share to buy the stock. This discrepancy arises from the significant number of synthetic shares that effectively trap the shorts, preventing them from closing their positions. This is precisely why the short and distort campaign against AMC continues relentlessly. If this campaign were to stop, it would indicate that shorts had closed their positions and moved on, no longer concerning themselves with AMC. However, their inability to close their short positions leads them to fabricate lies about the company's finances and operations, generating fake headlines daily to scare investors away. The skyrocketing short borrow fee and the excessive puts further indicate that the shorts are trapped in AMC and would rather pay the exorbitant cost to borrow than close their short positions. The persistence of the short and distort campaign reflects their ongoing short positions because they simply cannot exit them. If the campaign ceased, it would imply that they had stopped shorting and moved on, which is currently not an option for them. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.